I'm Andrew Karolyi, and I am a professor at Cornell University, the Johnson School, and the organizers of this conference, Bill Christie, invited me to lead a session on something that is interesting to me. And what I chose was the topic of emerging markets. It's, if you've seen anything that I've written in the past 25 years, you'll know that this is an active interest of mine. Global financial markets, I would say, and then certainly emerging markets. I have a presentation put together here for about 45 minutes, 45 to 50 minutes. So it would be wonderful if people were ready and willing and brave to pause and ask me things along the way. It's a funny title, right? I'll tell you why the title is chosen the way it is. What is the Enigma? What does cracking mean? Emerging markets even, I'll tell you what I mean by that. That's not even an easy answer. But I'm looking forward to an active engagement. And I hope you'll see the purpose of what I'm trying to do. Do I need to stand by the microphone behind a podium, or can I? Because Matt says I can walk around a bit, and that's more comfortable for me. And I think this will work if I walk around a little bit. So I've broken this presentation into 3 parts. I would call the first part is the framing of the issue, why we might be interested in cracking an enigma. And the middle part is where I offer you my deliverable, right, which is the sort of the intellectual content of the exercise. And then the back third is kind of what I would call new developments, things that I'm doing now beyond what I have shared with you in the middle bit of the presentation. So let me start there. Let me frame the question for you. So I'm going to call it the phenomenon in emerging markets in 2013. You would probably not have come here if you weren't at least somewhat aware of what might have happened during 2013 in the world we typically call the emerging markets. You should all be, if you're not sure what I'm talking about, you should start to be, what was it that happened? Well, I'm going to tell you a little bit about it. So, it starts here. I don't know if you can see it all the way in the back. John's sitting in the back. So on this is basically the cumulative returns performance over 2013 all the way into the beginning of 2014. The dark blue line on the top is the Morgan Stanley Capital International World Index. And the US had a good year in 13. It seems 14 is not looking as good as it once did 2 weeks ago compared to 2 weeks ago. We're giving back some of our gains this year. But clearly we were in the somewhere in the 20% cumulative returns area for the MSCI world. Now, by contrast, the light blue line is the cumulative returns performance in emerging markets over that same period of time. And I don't know if you guys can see anything unusual in the bottom line. It certainly didn't start out well. A wedge developed between the two, but then it quite dramatically widened, didn't it? And then it sort of recovered back and tried to catch up a little bit. It was kind of a 2-month span there, somewhere in the May, June area. Is this starting to jog some memories, maybe? Let me help you. It wasn't just stocks, by the way. During the 2013, this is from the Financial Times, a number of currencies were also quite, in the emerging market space, the traditional emerging market space, were quite intensely brutalized. The Brazilian real down about 14% cumulative over 2013. Turkish lira, 15% down. The South African rand, about 18%. A number of those countries at the bottom of the list are what a number of prognosticators and market watchers referred to as, I don't know if anybody remembers this, the something five, the fragile five. They came to be known as this fragile five. There's a few saving graces there. The RMB, I guess 2 Eastern European, 3 Eastern European, 4 Eastern European currencies. The won didn't get hammered too bad, but pretty much anything with a peso in its name was pretty much in the negative space here. Negative space. Now, I just want to focus your attention here. I'm kind of lower the microscope on the market returns. This happens to be just the 5 traditional components of what we call the BRICS: Brazil, Russia, India, China, and South Africa. And this is now magnifying that widening of the wedge that you saw 2 slides ago, intensely declining. And what's interesting is that they're all commonly co-moving downwards, right? It's all cascading downwards, all 5 of these major markets in the traditional emerging market set. And not surprisingly, I don't know if you guys can see this, not surprisingly, this is data from the BIS, and these are month in and month out equity and bond flows. Equity is blue, and bond is red, and obviously negative versus positive. These are into the emerging market space, generally defined. And you can see it year by year. Typically, you see many more bars on the top than you do on the bottom. And that's certainly been the most recent 2-3 year experience. And then, I guess 11 was shaky, and then 12 came right back, roaring back. Equity-driven flows, and hesitation, and then net 33. I mean, you can see this is quite an outlier, right? In the month of May, I'm sorry, that's June of 2013, we're talking about a net $33 billion outflow, 2/3 to 3/4 of that driven by equity outflows out of the emerging market space, June. And you see what's happening on the returns. It's coincident with what you're seeing in the flows. Have you figured it out, Ahmed?
No, I had theory question.
Okay, theory, okay, let's bring on theory.
It's a very basic question, I don't know. So, when we're talking about flow of money, let's say, this market,
Yeah.
in and out,
Yeah.
should I think of change in the net supply of assets, or I should think of everything being absorbed by changing the price level?
Yeah, it's a price levels you should think about. I mean, some of these firms that are the other side of these active or the bonds that are on the other side, there is ebb and flow of the issuance and, and the expiration or maturity of these instruments and so on. But really, we're talking about the outlet valve is the price.
So it means that if foreigner takes the money out, someone, the domestic person, should come and get it.
Correct. And you should imagine yourself that there are probably, I'm not forcing you to think that, but strong seller-motivated, seller-driven, seller-motivated price impact that is taking place here. It seems to be coincident with that. And it's all contemporaneous, although this is very chunky, right? It's cumulative monthly horizons here.
So your guess is that the causality comes from the brief.
I'm hinting at it. But I bet you there's a few people in the room that have already figured out what's going on here. In May, in fact, what happened in May and June. So this is the quiz part of the session this morning.
U.S. interest rate is people expect rates to go up in the U.S.
And why were they expecting rates to go up in the United States?
Yeah, Fed was expected to move a bit. It was there.
There was a hint from who?
The Fed chair.
Who?
The Fed time for the meeting.
This is why I'm suggesting causality or hinting at it here. So you would think that if there's something in the fundamentals here going on that's driving this, why is it that the almost pinpoint timing of the initiation of this massive exit out of broad cross-section of emerging market countries was taking place right around, you can almost pinpoint it to May 17th, when Chairman Ben Bernanke was testifying before the House, the the House and the Senate, the subcommittees, and he didn't really say that they were going to be ending the latest round of quantitative easing. But there was a hint, there was one particular word that he used in the testimony. We all know what happened. We all know what happened. It was officially announced in December of 2013, and we're now in October of 14 now. We are now officially ending our monthly bond purchase program. So it's now officially ended. And you know there's a new round of anxiety that's going on out there with the reverse impact of this unwinding. But he used the word, he didn't use the word taper, although the market watchers used it. He used this word. He called it normalizing. So what this quantitative easing program was in the aftermath of the global financial crisis was an extremely accommodative posturing of the Fed towards trying to relieve the pressures to the best extent that they can. And many people refer to this as rather unconventional monetary policy, and so he used the word unwinding of the unconventional, i.e. normalizing. And all market watchers on that day, May 17th, were just talking about, that's it, interest rates are going up. And so what does that mean? If interest rates suddenly in the US are going up, all those people that were piling into emerging markets, what was likely, can't make these associations so loosely, right? But what was their motives for piling into emerging markets in this low interest rate environment? They were grabbing yield wherever they could find it. Emerging markets were a darn good place to go grab some yield. And suddenly, they could come back home to find some yield because we were going to normalize monetary policy in the US. It wasn't a connection I don't think many people naturally would have made. I think it caught a large number of people off guard. And you see the market reaction in terms of the massive outflows out of the emerging market space. Well, this is when the taper talk, the talk of tapering the monthly bond buying program, drew out the reactions from people all over the world. For example, Mr. Zhu Guangyao, who says on behalf of his home country, it's a bit of a finger wag, right? We hope that the issuing country of the largest reserve currency in the world, the country that shall not be named, should be mindful of the spillover effects of its macroeconomic policies. Spillover effects of monetary policy became one of the buzzwords in policy circles. And we were leading into September now, seeing the chaos that ensued in those markets, leading into the St. Petersburg G20 Summit. And they were going to be talking about a lot of serious issues, but the G20 Summit in St. Petersburg was suddenly completely overtaken by the discussion of the taper and the taper talk. And the thoughtlessness in the actions of the US Federal Reserve towards not fully understanding the full global impact of its policies. And you can see China Daily, a little cheeky editorial cartoon. The countries, I think that's Merkel playing the cello there, I don't know. But they're all ready to play a nice concerto together, and apparently the US is not ready to play music the way others are willing to play. This is the kind of feeling that overcame people. Now, fast forwarding through the end of the year, you can see that this did not abate. It continued. The massive outflows in terms of stock and bond outflows. This is now a cumulative chart instead of the impulse chart we saw earlier from Morgan Stanley Research. And you can see that this is where the first hit took place, and there was obviously some sort of maybe anticipation. I don't know. I'm over-interpreting, but it certainly did not abate in the aftermath. It's starting to come back now. It's sort of easing, I would say, right now, but it hasn't been a big rally in emerging markets in 2014, if you fast forward all the way to September here. Now, in 2014, February and March, well, ladies and gentlemen, the taper tantrums aren't exactly stopping. So on the left, I don't know if you recognize the gentleman on the right, but you should. He was the keynote speaker at the FMA meetings 2 years ago. But the gentleman on the left is Mr. Alexandre Tombini, who's the governor of the Central Bank of Brazil. talking about the fact that there's a lack of coordinated exit from exceptionally loose monetary policy, and it was done at the expense of emerging markets. Hard not to assume or impute causality there, right? In his words. This gentleman is an actual, well, he's an economist too, but this gentleman is a financial economist, Ravi Rajan, who happens to be the governor of the Reserve Bank of India. He got that job not 6 months after giving a keynote address here 2 years ago. So that's what FMA can do for you. So international monetary cooperation has broken down. This is serious finger wagging. The industrial countries have to play a part in restoring cooperation. They can't, at this point, wash their hands off and say, we'll do what we need to, and you do the adjustments. So there you go, Mr. Rajan. Now, what's really interesting to me is that these experiences were very different over the course of 13. Look at Mexico. Very different picture. Oops, I was going to go backwards here. So you just, because I flew through some of those countries individually. You can sort of see very different. That looks like an indirect impact. That one looks like a slow and steady one in China, Argentina, Indonesia, accumulating and declining. Mexico never saw a decline. It was nothing but a cumulative.
What are you plotting?
I'm plotting cumulative flows. Sorry. Thank you. I was talking. Yes, I need to be qualifying. These are cumulative net purchases of U.S. investors in these particular countries that I'm accumulating here. So what do we have? We have some observations. Tapering top had sharp negative impact on emerging markets. It appeared to be surprising and surprisingly large. And if I've hinted to you based on that last little episode that the experiences in these different countries were rather different. So, some logical questions to ask. There are probably many more than just what I'm going to suggest. Which countries were particularly hardest hit by this Fed taper talk? Why were those countries hit and why not others? Is it related to, there's certainly a hint that there's something structurally wrong with the countries that were particularly most acutely hit. That's why market watchers refer to these fragile five. They didn't have their houses in order. They needed to engage IMF talk. They needed to engage in structural reforms, whatever that means, to bring their fundamentals, their external balances need to be restored. All these clever, complex macro talk. Which ones if they were fundamentals? Well, ladies and gentlemen, that's the end of my framing. And I'm going to tell you that I actually have some strong views on this. Now, it didn't happen to be my intention that this happened at the same time, but during the year of 2013, I was on sabbatical leave. And I had committed myself in first Cambridge, and then I was at the IMF during the second half when a lot of this stuff was swirling around. I didn't know what was going to happen when I signed on. Committed myself to writing a book about emerging markets. And it happened to be a very cool time to be watching and writing about emerging markets. And the book is entitled Cracking the Emerging Markets Enigma. I'm going to tell you why I wrote that book and what it is in a second. What I'm really proud to tell you is it's coming out in 2015. It's going to be published by Oxford University Press, and it's going to be published in what's called the FMA Survey and Synthesis Series. So the FMA, my dear FMA, of which we are all a proud part, is a beneficiary of some of what will come out of this book, of course, if anybody buys it and reads it. It is a trade book. It is a trade book. It is a book I intended to write because, honestly, I felt that the quality of the discourse in industry and trade circles did not reflect the quality of the discussion that we have been having in these halls in terms of the body of research that has been built up. I contributed a little bit, you guys have, a lot of us have. and yet you don't see the qualitative discourse. So what I wanted to do was provide a translation mechanism for the industry out there in terms of understanding what we have come to learn. Now, I knew I had to do it in a very special way to make it maximally effective. So here's what the book is about. And remember, the taper was not part of my thought experiment. That happened after I was already writing it. But what this book does is I argue a rigorous, comprehensive, and practical framework to measure the true fundamental risks associated with investing in emerging markets. It's rigorous because I am going to harvest our collective wisdom. I'm synthesizing our collective wisdom and putting it into a form that's digestible for the industry. It's comprehensive because I am going to actually define multiple dimensions of risk, right? Emerging markets versus developed markets. That's a rather coarse, right, 1-0 variable. And you know that it's a lot more complicated than that. We know it's a lot more complicated than that. There are multiple dimensions of risk that differentiate what we would classify typically as emerging markets relative to developed markets. And we know that from our collective research, and look at all the sessions that are going on in this conference on these qualities of institutions that I claim to assure the integrity of markets. Now, I knew that wasn't going to be enough to communicate it in a practical way for these people in industry. So what I do is I actually distill our wisdom by creating, nothing fancy, we can all do this, principal component, scores, of these countries based on these 6 different dimensions. And I'm taking, it's sort of like meta research, which we don't really do in finance, right? Other fields do, where you take results from many studies and compress them into these risk indicators or scores. And very intentionally, as you'll see, I do this not just for what we would traditionally classify as emerging markets, but rather do it for all developed and emerging markets. Sort of 57 countries around the world for which we have collectively done a good chunk of research on because there's a lot of good data on it. And then what I'm going to do is I'm going to let the data organically reveal just where Korea looks relative to the other countries, or where India looks relative to these other countries. And furthermore, not just overall, but on those dimensions that we probably care about, because research has told us those are the dimensions that matter. Anyway, so why bother writing it? I told you, to elevate the quality of the discourse that's out there in industry circles about what an emerging market really is or might be. Nothing more irritating for those of us who work in this area, and many of you do too, to take a student's or an industry person's question and say, well, is Greece an emerging market? Or surely Korea is no longer an emerging market. And I now am empowered to say to them, this is an uninteresting question you were asking me. I know that's cheeky, right? That's rude. You don't want to do that to your neighbor. But it's an uninteresting question. On what dimension do you mean? Is it emerging or developing? So that's the thing. I also utilize this opportunity to define what I really think are emerging markets. This is the first line in the book. What are emerging markets? They are underfunded growth opportunities with problems. What problems? Chapters 4, 5, 6, 7, 8, 9. I create these buckets of risk indicators that I've artificially harvested and compressed. I guess this is where my hands are, is I've taken this stuff and said, that's kind of one thing, and these are kind of one thing, and then within them I distill into a single index score. That's what I do. Why bother? Well, I told you. Refocus attention. Certainly, I mean, Jim O'Neill at Goldman Sachs Asset Management, when he first coined the term BRICS, did a great service in focusing our collective attention on these interesting countries that are fast-growing, high-growth potential. But he did us also, at the same time, a great disservice by forgetting to tell us what really matters in these countries, which is not what why they are growing on a realized, a realized growth path that is high, or prospectively high, but what might be inhibiting them from being even higher and sourcing capital to fund those opportunities. That's the story of emerging markets. It's emphasizing multiple dimensions. The question should no longer be, after this book, I hope, are you an emerging market or are you not, per Morgan Stanley's definition, or the Economist Intelligence Unit's definition, or Goldman Sachs' definition? I don't want to talk like that anymore. I want to say, well, in which dimension do you mean? Is it more like an emerging market or more like a developed market? I want to stop the endless race to coin the newest silly acronym, BRIC. BRICS or BRIC? Boring question. N11, another Goldman Sachs asset management term. The next 11, O'Neill calls it. TIMPS, CIVITS, MINT. They just go on and on. It's like somebody's trying to race to coin the cutest new acronym that is vacuous and meaningless. And maybe it's useful to explain how actual investors think. And for academics, maybe if you're not working in this area and you want to know what's going on, this would be a nice couple 100-page way of catching up on that. It could be used as a teaching tool, I guess, as well. Questions?
Is it more on the macro perspective? For example, you moved into the discussion, you talked about monetary policy, and my interest is in independence.
Yes.
And you say that you say, oh, all should cooperate at that time, but when we need to fix our own economy, we'll make the decision without cooperation.
Yes.
So this raises another question. How much coordination should be?
Yes. I'm not going to answer that question, but I really appreciate the challenge, right? You're implicitly challenging me. Is this a macro book? Are you going to be talking about current account imbalances and capital account imbalances? And that's not really, no. Because I'm taking an unapologetic position of the investor perspective, sizing up these markets, trying to get inside of the people whose feet were moving in May and June of 2013. That wasn't in my head at the time, but that's the perspective I took. I should be admitting to you right now that this didn't come out of nowhere. I actually was working for, let's call it a major asset management firm for a number of years, and this was one of their big projects. They already had their strategies in place, but what they were asking me is, into which countries are you maximally, should we be strategically avoiding in terms of the emerging market space, the traditional emerging market space, such that we should not take our strategies there. So it's an unapologetic perspective of the investor. It's the origins of the project. I have no hesitation in sharing that. I am not trying to get inside the head of Olivier Blanchard or Raghu Rajan, but there are implications for those people in the stuff that we do research. Surely there are, because they're watching financial flows intensely. You know they care, so they're linked. But my focus is on the investors.
One additional question.
Sure.
You go on lean on institutions. Is that a big factor that comes?
Well, I'm going to tell you what institutions I mean. When I use the word institutional quality, I mean it very broadly. I'm going to show you in a second, right? It's what we call institutional quality. You guys should be thinking, what is he thinking about? I bet you know what I'm going to get to, right? I bet you know it. Go ahead, Amy.
I'm quite interested on the multiple dimension of risk, but in terms of the risk, is the political risk or the enforcement risk or something in terms of the governance risk?
Yes, yes, and yes. That's buckets 6, 5, and 4.
So
The ones you listed right there.
That also like which specific risk might be matters more.
Yes, yes. That's what I'm going to do. You've already figured it out. So what are my 6 buckets? All right, here they are. The natural one is the underfunding problem is that there is not sufficient funding being generated domestically, right? Many countries do have large, growing accumulative savings pools. China has a very large, domestically generated, slowly, as Theo, that is supporting their growth, but it's not enough to support that sustained high target level of growth that they expect. So they need external financing. They're very careful about how they draw in financing. But it's natural to focus on local domestic market capacity constraints. These are traditional measures. In fact, I would argue things like GDP per capita are exactly at the front, right in front of the nose of the Economist Intelligence Unit when they say these countries are above the line and these countries are below the line. It would be a big mistake for me not to include these measures of traditional market capacity constraints, turnover ratios, the size of the private and public bond markets, new issues to GDP. These would be the variables that you can imagine collecting data on these, right, across countries, across years, and then compressing them and creating some sort of principal component, right? You can imagine. You can even imagine where you get this data. Many of you work with this data. Right?
Yeah, basically. So I'm looking from the perspective of the welfare of the host country.
Okay.
So is there, even if there is a difference between portfolio investment and through the stock market versus conventional
FDI.
FDI.
Yeah.
So you answered part of the question because you said it's not through the change in the net asset supply. So if everything is going to reflect just changing the price of the existing assets, it's just a zero-sum game like equation, it's not necessarily going to...
Hamed, this is an excellent question, my friend. I am unapologetically focusing on the investor, and therefore you should interpolate that as being focused on the portfolio investor. Yes. However, I would be remiss not to say that there's probably significant implications for that for the foreign direct investment flows. And you know there's strong simpatico. In fact, I saw a paper on the program here looking at studying the joint dynamics of FDI, FPI across countries. You know they're intricately connected.
So you think this is a proxy for the aggregate?
You can. I'm suggesting that somebody who's a company in India thinking about making strategic investments in acquiring assets in sub-Saharan Africa would not be uninterested in some of these risk indicators to guide them in their decision making. Though I did not necessarily have them in mind as I was putting them together, it would not be uninteresting to them, right? Oftentimes they're co-investing with the portfolio investors, right? So the next natural one is what I call generally operational inefficiencies. We stop at 10, right? Yes, we stop at 10. I'm glad you're asking questions. More people should be asking me questions and telling me why I'm wrong. You should be definitely doing that. So operational inefficiencies is fun. Brokerage commissions, transfer taxes, market impact costs. I'm going to show you, I'm going to hone in on this one to kind of showcase it for you. Lots of illiquidity products. Lots of people doing research on market microstructure around the world these days, including in emerging markets. I harvest that data. I use those people. I borrow from them liberally. Really interesting papers on market mechanics, like short sales constraints, on restrictions on insider, well, that comes later, insider trading, but certainly exchange trading rules, the intensity of exchange trading rules. Some great work by Doug Cumming and his colleagues looking at this around the world to try to explain things. Much less of interest among academic research, and this is another thing that I think comes out of the book, is that there are some really interesting subclass areas on which we really haven't done any academic research, which, for example, is in the plumbing markets. Finance guys don't seem to really find it interesting to study settlement and clearance cycles. And the risk management systems of the central clearinghouse authorities in terms of operational efficiency and how they manage their risks with respect to something that industry people are very much focused on, which is trade failure risk. We don't really get data on it. It's not easy to get data from the respective clearinghouses and the central registries, but yet it's of significant importance to any de facto delegated investor representing on a fiduciary basis their investors are taking money into these countries where there's, a 4 or 5% chance that an agreed upon transaction may not be consummated because something got lost in the mail. So I've collected some data on settlement and clearing systems around the world and the different mechanics around them, and use that to part of the score. Even though there's no academic research, I supplement that's just an example. I'll show you more on that. Obviously, we have to talk about investability restrictions, and there's a whole host of ways in which we do this. This is going to involve accessibility scores using these S&P IFC traditional metrics. A lot of research uses those. Registration rules, ownership restrictions, foreign exchange convertibility limits, withholding taxes. Do you have double taxation treaties? With how many countries do you have double taxation treaties? To relieve some of the tax exposures associated with an investor taking their funds overseas. Bucket number 4, corporate governance, corporate opacity, traditional governance rankings, CLSA, S&P, ISS, many research papers being written using those, even in this conference. Accounting standards, scores on intensity of earnings management. Many people say that reflects something about the quality of the standards, or in effect, right? Blockholder control, closely held shares, analyst following. All of those, there's lots of interesting research from accounting that spills over into this, international accounting that spills over into this particular institutional aspect of the markets. Limits on legal protections. You know these ones. You knew this was going to be a bucket, right? One of my risk buckets. Arguably in the last 20 years, one of the single most transformational bodies of research in the whole field and discipline of finance is the law and finance literature, inspired by names you know, right? Lopez, Solanas, Schleifer, Laporta, Jankov. And so I harvest much data from them and their studies, but also a lot of really interesting data from the World Bank doing business indicators, or world governance indicators, excuse me. Data on insider trading laws, I mentioned that briefly as well. And finally, you knew this was also going to be here, political instability. Well, ladies and gentlemen, we've only scratched the surface in finance about all the potential that's out there in the political science literature that we could be importing to understanding the potential consequences. And there's some really great people working in this area. There could be a whole lot more people working in this area, in my humble opinion. But I use data that involves the database on political institutions from the World Bank, PolCon, Polity 4, this is Ted Gurr and his team. PolCon is political constraints measure. Vince Hennis, who's a political scientist at Wharton, Business School at Wharton, he's developed this. Too few people are using this high-quality database on the intensity of the concentratedness of political power in the respective decision-making bodies in each of these countries around the world. This was, I mean, I had fun doing all of this, harvesting all of this stuff. But I would say, relative to what I had previously known about the world of political risk and political instability, this was one of the most fun I had, was delving in, deep diving into this literature in the political science world towards all of its potential for us. This is also where you get a lot of the World Bank governance indicators on voice and accountability, regulatory burden, rule of law, Transparency International's Corruption Index, Heritage Foundation's Freedom Index, which is all encompassing. These are all compressed in there. Are you getting a sense of what we're doing here? Now, you could say, well, wait a minute, why is that? Why is that not over there? And that could be over there. This is my discretion. I clump things together, and I decided 6, not 7, not 5. And it was it's sort of a lot of arbitrariness here. But remember what my objective is, to elevate the quality of discussion, focus in on a reasonable subset so that people in industry understand that it's not just are you above the line or below the line, but how do you sit relative to your peers in these respective dimensions.
So listen for you. So relative to your buckets, I can see how you can distill information for each country, right?
Good, yeah.
But where do you capture the linkages among countries, right?
Right.
So the spillover.
So the commonality in this.
So some of one place affects another place, right?
So my short answer would be, I allow the data to tell me. Because that's what principal components analysis does, is it harvests the covariation, common covariation across countries over time in each of these indices. And what it does is, remember, what it's trying to do is identify the elements along the eigenvector that generates the highest eigenvalue, right? That is basically representing this vector of elements that singly maximizes the variation of all of this data across countries and time. So I'm letting the data define the commonality. If there's not enough commonality in some of these scores, on some of these subcomponents of a component, right? These elements of the component, they'll get a lousy weight. And there won't be statistically significant in the weights. And the weights are going to be here. Let me show you this part. This is the mechanics stuff. I appreciate feedback too. I wanted to do this. I know that it's not commonly understood in trade circles, but this is off-the-shelf standard template multivariate statistics in the world of scholars like ourselves, right? So I wanted it to be very transparent methodology, very transparent, that you could do yourself. Given the data, you got half an hour, go compress and construct the principal components. Yeah, and I use some discretion and I, operationalize. I've done this in a few papers, so I have a little practice with it. So it's 3 steps. Harvest, pick the papers. I guess one advantage of being old and having stuck around for 25 years is I've read a few more papers than people that haven't been around as long, right? Probably being an editor helps. I read lots of papers. So I felt like I had a pretty good feel for what the papers were out there, and if I didn't, I dug them out, right? I harvest them, combine them with other useful data, like I've already hinted at, and then I compress and create these indices. And I'm going to show you the example for operational inefficiency, just one of them, just so you can see. So that's a really good study that looked at liquidity risk around the world. I happen to know that person. It was published by JFE in 2010. Lots of emerging markets, not just, but lots of emerging markets were featured in this study, looking at basically an output measure at the individual security level, aggregated up to create a market liquidity measure, and then what he was interested in doing, what we was interested in doing, is measuring the price of illiquidity risk. But he shared in table 1 of his paper, he shared the actual average liquidity risk measures for the individual securities, country by country by country. Grab and steal, it's in the public domain, grab and steal, stick it in, right? Why not? Wonderful source of data for those who are interested in doing more research in clearinghouses and the integrity of clearinghouses around the world. This happens to be the 2010 survey that I used from the World Bank. It's all in the book, you can write it down if you want. But it's called the Payment System Worldwide Survey, Global Payments System Survey. Elkins McSherry, a commercial vendor that happens to work as a consultant on behalf of large institutional clients. They collect and harvest the data of their respective clients and report summary statistics on market impact costs, transfer fees, transactions costs, and also commission fees around the world. I reported at the country level. Thank you very much. Grab and steal. Stick it in the indicator. Let's see how it goes. Studies looking at, this is a 2011 study looking at short selling restrictions around the world. They actually have data from various sources. Somebody's slipped my mind now, the original data source. Some of you guys might remember it. Anybody? No? Okay. It'll come to me later. Study on exchange trading rules around the world by Cumming. I mentioned that one as well, by Cumming. This is a wonderful paper, working paper. They gave me permission to allow them to use the summary statistics from their SSRI working paper, looking at proxies for illiquidity around the world. Fong, Holden, and Chuck Trzynka. Chuck Trzynka was just down the hall here. And they were kind enough to give me permission to use this data. The summary statistics, cite the summary statistics from table 1 of their paper. And this one I happen to have my own little contribution with Dominic's advisor, Matthias, from Rotterdam, and looking at commonality and liquidity around the world. Another sort of set of proxies for liquidity. So we all throw these into a bag, we shake them up, use standard template econometrics, statistics techniques to see what comes out. So here's some of the data and what it looks like. So there you go. There's the data from Lee, there's the data from Fong et al. Here's the data from the World Bank on the cycle. Some of these are 1-0 indicators. Some of them I construct From the survey responses, like LLSV style, I add them up. Did they say yes to this, this to this, this to this, 3 out of 3, 2 out of 3? All explained. So these are all new things that I build. These things I'm stealing from other people, right? Stealing from other people, taking from other people, commercial vendors, right? There's the coming data. And what happens is you shake it up, and then some of these guys get higher weights, and some of them get lower weights in the construction and composition of the indicator scores. So these are the ones that shake out and get good heavy weights, which is interesting unto itself, I think, right? So it's hands above the table, right? Because many industry people will say, well, wait a minute, why did you give such a heavy weight to variable A and such a low weight to variable C? And the answer is, I didn't. I let the data tell me what weights to impose because of the algorithm embedded in principal component analysis. Right? And very interesting. Brokerage commissions, you'd think that would be secondary to market impact costs, but yet that got a good weight. This FOM, their favorite measure on zero return proportions as a measure of illiquidity, gets some nice validity in the construction. Nice, healthy, cross-country, cross-time variation in these. There's this delivery mechanism, the DDP indicator seems to have some juice. Short interest ratio, manipulation. Oh, and equally interesting are things that sadly don't get much weight. Gosh, data from my own published paper. Was sad to see that it didn't give any weight, but yet, this is the reality of the world. Tough beans, right? You're asking questions, so.
Alternatively, of course,
nobody's walking out yet. That's very good news. That's very good news.
I think we calibrate it against market rates. So I'm sure you have tried that.
Which one? Against actual prices?
Inputs versus looking at CDS of countries or premiums, etc.
I haven't yet. Wouldn't that be a smart thing to do? I'm going to show you where the natural thing is you build these things and you need to validate them. The third of the book is validation, and I'm going to tell you about the validation exercise, but it is not what you suggest. Maybe it should have been, but I don't. I'll tell you what I did.
Of course, if markets are not smart or efficient enough, it won't work.
Well, it shakes out in two ways, right? The way I see this, it shakes out in two ways. Prices are P or Q, right? Prices are quantities. I chose to validate these scores in the third part of the book on quantities. I wanted to understand what people actually do as global investors, see if these risk indicator scores have any bearing on how investors actually behave. I look at flows, stocks and flows, stocks of holdings and flows, as you got it. But I chose not to look at prices. I could. Other people do. But not with these indicators yet. Maybe some of you will use these indicators and go do that exercise. But here's the actual raw output. This is actually, I dare to put this in the book, even though I know industry people will never look at this. But this shows you the honest weights that these scores get, their standard errors, the implied Z statistics, the standard error, the ranges, and so on. This particular one, I used ultimately 4 components to get over our minimum threshold of variation that I imposed. There's a lot of discretion I used. As you know, when you do these kinds of things, you have to impose some discretion. The nitty-gritty details are in there. And I show you, these are the ones that got the weights. Sad for Karolyi, Lee and Van Dyke, no good, bad news, move on. So this is how the book is organized, Common and everybody else. I set the stage, okay, talk about what I'm trying to do. Part 2 is the heart of the book, the 6 main chapters for each of the 6 buckets. And then the third part is validation. And then conclusions and lots of caveats. Be careful how you use these things. But this is what I'd really like to tell you about, my 3 experiments on how I validate this, okay? But here's a little bit of data on what these things actually look like. So these are spider diagrams or radar diagrams. You've seen them before. You probably made them yourself. This is a nice way to illustrate the scores for a given country. And this happens to be for the class of traditionally defined emerging markets by, let's say, Morgan Stanley Capital International and the developed markets. Positive scores, good country. Negative scores, bad country. Uniformly defined across the 6 buckets. So the more you descend into the middle of the spider web, the worse is the country's score on that dimension. And you can see that what you don't have here is sort of like a nice hexagon. It's kind of oblique. a little wobbly, right? These are the developed guys. Naturally, they typically have, you would have expected them to naturally have more positive scores on each of these dimensions. Emerging markets, traditionally classified, lie within side. Interesting, the gap between operational efficiencies is large, but yet, interestingly, the limits to legal protections between the traditionally defined class of emerging markets and developed, not so big on this dimension. And remember, I'm compressing across all 57 countries in my sample, not just emerging, not just developing. I'm letting the data tell me where these things shake out. And I thought that was kind of interesting. Corporate opacity, that's like the Grand Canyon between the two of them there. That's a massive difference between the two countries. We know this. We know this in our research. Here are some individual countries. So now you see the wobbliness of individual countries and how they shake out. You know that somebody like Raghu or whoever's the head of the India desk at the IMF is going to be saying, wait a minute, Karolyi, that doesn't make any sense. That's not what we think. I said, okay. This is the collective wisdom of the academic research community. It's not me. They're talking through me to these scores. So maybe you should rethink your score on how you think about this stuff. Brazil it's sort of a nice shape here. Russia, if you stuck that funny triangle thing, it would almost fall inside of Brazil. Russia has definitely got worse scores on average than Brazil on each of these dimensions. India is really not too bad when it comes to its legal system, according to the data, not according to my opinion, okay? It's not my opinion, it's the data that seems to suggest on legal dimensions, India scores quite well. Common law country, I don't know. Operational efficiencies in India are pretty good. There are certainly more I played with the scale here a little bit, so it's common across the 4 countries, but a little bit falls down here, a little bit falls down here. Certainly, foreign accessibility restrictions bind when it comes to a country like India. What about China? How strange is China? China, a true enigma, right? We really want to crack that enigma. But market capacity constraint, China, has a pretty healthy, vibrant equity base by reasonable arguments. Operational efficiencies, at least de jure on paper, looks pretty good in terms of the risk management systems they have in place for their clearance and settlement. Blue chip, gold standard stuff going on there in China. It really scores quite well. Not quite, traditional developed markets standing, but certainly not horrible there. Foreign accessibility restrictions, we talk about that all the time. To me, this was a big surprise. Many people say that is the single biggest binding constraint on China's success, is their slow rate and pace with which they are opening up their capital account for foreign investors to access. The QFI programs, the QDII programs, all of these things. Maybe not so much. If I were recommending anything to our friends at the Chinese Securities and Regulatory Commission, would be to do something about their very low scores in corporate opacity. That seems to be what really drags China down in these raw scores. Political instability is kind of a weird thing to penalize them for. It's very stable in China. It just happens to get very poor scores on things like political constraints, because you have a single party in the relevant decision-making body, right? So it's not very fractionalized. Here's how the overall scores rank. This is interesting to see, right? Bad scores negative, good scores positive. There's the median developed market of the 24 developed. And you can see some of these guys, gosh, you can see why people say Korea's not really an emerging market. And I say, well, okay, but what do you mean by that? And it's true. Look at it. It's there. And there are some definite countries down here, Argentina. This happens to be for 2012, which are the scores I'm going to be using to rationalize portfolio holdings in 2012 and portfolio flows in 2013. The taper experiment is going to be my outcome experiment, my third major outcome experiment. I'll be taking these scores. Now watch this. I'm going to preserve the ordering of countries here. Just visually watch this. And I'm now going to show you each of the 6 separate buckets. And you'll watch those bars actually changing place. So the average score, which is this, across the 6, is this ranking. I'm going to preserve the ranking, and now I'm going to show you how things shake around and move around across the 6 buckets here. So there's operational inefficiencies. It's still a heavy dose on the left, top, but not as linear, right? For accessibility restrictions, many of them get poor scores. Almost all of them get poor scores, except Poland. Corporate opacity. It's not as nice, clean, and linear, right? Each of these indicators offers something different to the story, right? And this is the legal protections. Look at this one. I worry about this because it's so compressed. It's almost homogeneous, except for a couple of really standout disasters like Venezuela. Most of them are very closely compacted. I worry for its potential in terms of its cross-country variation to be able to explain anything in terms of quantities or flows. So I've got my eye on this one. And then you all want to know about across time. So here's my score in 2012 for political stability. So I'm sorry, I should have told you. Hold on. Going backwards. Time out. This is an exciting visual, so I want it to go well. This is the score. I've reordered the countries from what I just showed you. I reordered them based on the political stability score in 2012. And now I'm going to show you snapshots in different years so you can see how things are moving over time. As they should. As they should, right? So here we go. It's pretty steady, but there is movement happening here. Countries are shifting this way and that, but there's not a lot of movement. But that makes sense that there should be a lot of movement in things like this. There should be changes, elections, right? Things like that. So that gives you a sense of a taste that these risk measures are moving through time. Okay, last part. Questions?
I wonder when you were looking at the principal component analysis, how many eigenvalues were significant?
How many principal components were needed? So I made an artificial rule. Good question. Good question. And I would say I'm liberally drawing from the existing literature, but I chose to define my threshold arbitrarily at 50%. I wanted to use as many principal components as I needed to just get over the 50% mark in terms of the unconditional overall variation. If one principal component got me over the top, I stopped at 1. If I needed 4, like operational efficiencies, well, so be it. And then what I did is I compressed the 4. Tell me if this is crazy. I compressed the 4 principal components and did a weighted average based on the relative magnitudes of their eigenvalues. So that the ones that had the highest eigenvalue would get the largest weight. So I compressed further. There's a lot of compression there. But I wanted to make sure that people understood that these indicators captured a healthy fraction of the unconditional variation across countries and over time. So I used the 50%. Could have done something else.
So basically, you have variable inputs.
Variable numbers of principal components across the 6 indicators. What do you think? Okay. I want some reactions. I haven't gotten many reactions from existing readers on that.
You go the other way around. So you take the entire matrix and then do the principal component analysis, then compare with the validating mechanism of random variability.
Yeah, you could.
To extract important eigenvalues, then the largest eigenvalues will give you the magnitude of the components.
That's right.
Which will be the most important.
Right. Right. The weights inside, the elements of the eigenvalue.
The weights inside, and then go to the second one and the third one. So in certain specific cases, you need to use rotational random shuffle.
You'll tell me more. You'll give me some readings to do afterwards.
Okay.
I figured. You sound like you know. So if I talk to industry people, like this conversation, it's okay in this community here. We're all family here. But if we went outside and you started saying that to people, and there's people from industry, their eyes would roll into the back of their head and just fall down. You think?
We have more and more engineers and physicists and mathematicians in the industry.
Doing this stuff.
So
Yeah. doing this stuff. So they can appreciate the technology. Good answer, good answer. Okay, you already know where I'm going with this, right? Third part of the book, chapters 10 and 11, is validation. And so what I did was I took 2 sets of data on holdings and 1 set of data on flows. You already know what the flows data is. It's going to be the 2013 taper experiment, taper talk experiment. I'm going to collect the flows across countries and look at them over the course of 2013 and see if I had no intention to build these indicators to explain those. I call that my faux out-of-sample experiment. That's exactly what I call inside the book. It's quasi-out-of-sample experiment. These were not built for this purpose, but it happened to be happening at the time, so what the heck, let's have a look. But the first experiment I wanted to do was look at holdings. You all know about the home bias. Well, there's the second most important thing called the foreign bias. Conditional on what investors hold outside of their home country, what fraction of that is deployed into country A versus country B relative to some benchmark. Typically, we use the market capitalization of the country. We look for the excess, the overweights and the underweights of our holdings outside of our country and see if there's some sort of rationale for it. Lots of research, and I certainly survey that research. I contributed a little bit there too, historically going back. Some wonderful papers. For yesterday, people who were here at the assistant professor's breakfast, Kai Lee was sitting with me in the panel. She's made some wonderful contributions on the foreign bias. Lillian Ng is here. She's got some of the greatest papers out there looking at the home bias and the foreign bias. So those are featured in this chapter. But I wanted to do it myself, and I picked off data for 2012. 2 sets of data. Number 1 called FactSet Lion Shares. Anybody used FactSet Lion Shares in the room? Okay, it's incredibly expensive. 50 grand or something. I don't know what you paid for it. Global institutional data. It's about $23 trillion in assets under management. Institutions only, heads up. Of the 23.6 trillion, and this is literally from anywhere. We're not talking about the 13F filings in the U.S. We're talking about Dutch the Dutch Post Office pension fund, the Australian superannuation fund. Anybody that is reporting to the respective authorities in their countries has been harvested by this FactSet data on holdings outside of the home country. 6.3 trillion of the 23.6 is the typical fraction of foreign deployment by these institutions. So what is that? A quarter of the pie, 25%. What is the average institutional foreign deployment in the U.S.? Would you say higher than 25% or lower than 25%? This is the second part of the quiz of today. Any guesses? It's much lower. It's much lower. It's about 13%, 14%. Many other countries are more progressive on this dimension. And the second one is Treasury International Capital. This includes, and many of you have used TIC data. TIC data for any international research you've done? Yeah. So this is, of course, not just institutional, but retail. It comes through the custodial network here in the United States. State Street and all these guys feed into this. Federal Reserve and collects it. 7.9 trillion deployed here for the U.S. That's featured. And my focus is on excess holdings relative to the Morgan Stanley Capital International All Capital World Index weights. So that's my benchmark. So are we overweighting China and underweighting Malaysia? Are we overweighting this, underweighting that? So here goes the data. This is what the FactSet data looks like. This is now the world. How does the world look in terms of the 33 countries in the emerging markets set? And you can see, this is not just US guys, this is all major institutions, the European guys, the Asian guys, the LATAM guys, anybody who's deploying money overseas. We really like Taiwan, relatively speaking, relative to its market capitalization. We like South Africa. We don't like Russia. We don't like Turkey. And China is way off the scale relative to its market capitalization. Huge underweight, minus 8%, just off the charts underweight. And you sit there going, well, yeah, but China's made it that way. It's hard for foreign investors, institutions, to gain access to China relative to the potential that is there. So none of this is, I think, surprising. Okay? But again, the hope is that that, you know, if this is all about China's restrictiveness and foreign accessibility, well, bucket number 3 should pick that up. And maybe the others don't have anything to say. Well, let's see. I'm going to let the data now reveal itself in terms of its potential explanatory power for the cross-country over and underweights. This happens to be for 2012. Yeah.
It just reminds me, maybe on the level questions, how about those cost-listed stocks come from China?
Yes,
Alibaba,
yes. So I've written a few papers on cross-listings. They are included. So that measure is included in foreign accessibility. So that's one of the things. I stole some data from an old Deutsch et al. Study that reveals the fraction of companies that are listed from that home country in U.S. markets, and use that as a proxy for accessibility. So that's where it would be on the right-hand side. But the flows in FactSet recognize that, for example, the Dutch Public Pension Fund may choose to hold Chinese shares in the form of New York listed ADRs. That will be reflected in these holdings. So it'll be there and there. It'll be there and there. And this one will only be in one bucket. Anyways, let's have a look-see. Quick look-see. Oh, this is the U.S. data. I wanted to show you how the U.S. investors look at these countries and over and underweight them compared to the rest of the world. Keep going backwards. Have a look. Korea is a big overweight here for U.S. investors, relatively speaking. South Africa, well, it was already pretty good here. U.S. guys like it even better. Brazil now shows up. Look at that. No story on Brazil. Brazil is of particular interest to U.S. investors in terms of an overweight, revealed overweight. Very interesting. Where I'm going to try it. And China is even a stronger underweight for U.S. institutional investors than other institutions around the world. By choice, by constraint, or by choice? I don't know, right?
How does this play this very asymmetric presence of investment from U.S. to China versus China?
I'm not seeing a good research paper on this.
Because China is the second largest holder of U.S.
Yeah. There are some Chinese institutions in CIC and stuff, Chinese Development Bank, are in the database in LionShare's FactSet. This is a hugely underexplored database. To now, until this became available, which is only like 5 years ago, people have not been able to study the relative over and underweights of the foreign bias depending on your country of domicile. Now we're able to do something like this. The potential is there. Short answer is I have no idea. I don't know. Anyways, let's have a look. Here's the answer. Simple regressions. I wanted to make it as simple as possible for out there. And the answer is, hey, these indicators not so bad. I mean, I write it in a very, I'd like to think, modest way. I'm not solving the world here, but it's not bad that these things work. Maybe I should never have been surprised, because remember, I'm getting all this information from you. And you guys have written all these papers that it had significant relationships. So why should I be shocked that these things actually, in spite of my handling of them, should not, not be bad and work out? Simple cross-country regressions. You can see that they're reliably there. That's fine. But they're also economically interestingly there. So, for example, on my corporate opacity score, a 1 standard deviation increase in corporate governance standards from by my measure, from Philippines to South Africa, that's a 1 standard deviation increase, is associated with a 0.98% increase or in overweight or 0.98% lower underweight. Now that's a pretty juicy chunk of change if you look at some of those over and unders on average across countries. Let's say for like those two countries, that 1% swing could be a huge, huge dollar magnitude difference. And it's interesting to me that I refer to these as my 3 softer risk indicators compared to my 3 traditional harder risk indicators, capacity constraints, foreign accessibility restrictions. That's usually what people focus in on. These soft ones are at least as interesting. There's good reason for us to be doing research on governance problems in emerging markets. They're interesting, relevant, and meaningful for how people think. That's what I'm showing you here. Keep doing it. Legal stuff too. Political instability. We should be doing more on this. 2013 flows experiment. Are you ready? I don't know what I was expecting going into this. And I've already told you what this is. Here are the actual flows. I showed you actual pictures one by one of this. Lots of cross-country variation in the experiences. In countries like Mexico, they were actually accumulating foreign portfolio flows during the taper experiment. What were they doing so right? Whereas countries like the Czech Republic and Argentina were getting shafted like crazy. And it turns out not so bad. Now these harder indicators are okay. Operational efficiency. So this is saying which countries did institutional investors most acutely avoid, or which of them did they attract new inflows to, positive scores, negative flows, negative scores, also a positive coefficient, right? And you can see that, for me, what was interesting, the way I was writing it up, I mean, it's not heroic, it's not over the top, 15, 16, 17%, but there's a lot of noise in this data, in these flows. There's not a lot of great, I mean, if you look at any papers that have looked at studying these flows across countries and over time, getting 15% explanatory power for this stuff, not too bad, not too shabby. What I was endeared by is that these, again, softer measures of risk indicators seem to come to the fore as being even more relevant. So it was like the governance concerns are as important as a fundamental risk that triggers attracting flows and represents an inhibitor to flows as anything to do with formal things like foreign investability constraints, right? The fact that you couldn't get into China or get out of China was not the reason why people were exiting out of China flows with respect to U.S. This is with U.S. data. There you go. Okay, how are we doing? We still have about 13 minutes. I was going to tell you a little bit about stuff that I'm doing since. This book, having been written, now inspired me to do a few other things with some interesting data. Any questions about what I'm doing or suggestions on how I could do it better? No thoughts, reactions? So, what's the next logical thing? Go ahead.
The question is, the motivation was good for the company and then showing that, okay, I developed this, now let me see the benefit of it, the sweet data set. And you got it. Now the question, who does the mechanism?
Wow. What do you think is the mechanism?
The question is, like, all the factors we see.
Yeah.
Like, why they are going to affect what we see?
Why these, not those? Why this particular?
And how specific it is about channels. So is there a discussion?
Yeah, no. I mean, way too high level, right? And this is where you guys need to pick it up. This is where you guys need to pick it up. I mean, I don't know. I'll tell you what I have done is this. This is the next thing, which is I want to know the mechanisms. I want to know who. I want to name names. Who were these institutions that so rapidly exited out of emerging markets and get inside their heads? I happen to know a few characters out there in history, and I'll spend some time with them and ask them these questions. I'm not going to reveal their names. They were part of the inspiration for the original writing of the book. But they were very hard, steadfast. The ones that I talked to said, oh, we didn't care what Bernanke said. We held steady through all of this. We saw many people taking crazy actions all around us, but we were not doing it. So, but I wanted a little more information. I wanted to know who. So, in the middle of writing, this is not written, okay? It's a PhD student at Judge Business School in Cambridge who's visiting in the fall, in the spring, in the spring of 14. So we're still working on this. And it's tentatively called Racing to the Exit, Emerging Market Mutual Funds During the Fed Taper Talk. Like, name names. Who were these mutual funds that were taking these actions? And which of these risk indicators were inspiring, can we correlate with their choices, the actions they were taking during this short, sharp shock, the unexpected shock that took place in May and June of 2013. So 312 active emerging market mutual funds from around the world with Morningstar individual holdings data, we have clearly not exploited the potential of this database. $318 billion in assets under management, 312 funds I mentioned to you. So what I'm going to do is I'm going to steal from the literature that study mutual funds and actions that they take. I'm going to build two things and share with you at a high level. Two things. Number one is the active bet or active share of Kramer's and Petty-Easto. Active share is a measure of conscious actions that a fund or institution takes with respect to their holdings relative to some sort of benchmark. And so they actually measure sort of like the weighted average of the absolute deviations of a holding relative to the benchmark. We call it active share. We're going to do that at a country level for these emerging market mutual funds. So, Janus Capital's emerging market fund was holding 12% in Brazil. Brazil's relevant weight by the MSCI was 10%. They were taking a 2% active overweight on Brazil. In December of 2012, all chaos ensues. Did they take down their 2% active overweight? Did they widen it? Depending on what was happening. So this is what we're going to do. We're looking at the active bets, and then, stealing from Judy Castillo et al., a wonderful paper in the Journal of Finance, that we're going to measure something called flow-induced fund allocations. This says, whatever you were holding, you experienced flows, inflows. Remember what Jonathan was talking about yesterday? Flows behind you, right? Investors coming in and out of your fund. He called that the relevant measure of performance. Should be looking at prices of mutual funds. He was looking at flows. Some of you were there, right? Some of you were there. And so we collect data on the flows into these 312 mutual funds, look at their allocations across countries as of December, and we look at the flows in May and June into these funds. You can get it at the monthly level. And then we measure collectively the flow-induced pressures coming from their clients through the mutual funds into the countries, and looking at which countries attracted a lot of flow-induced pressures upwards, and which ones had got a lot of flow-induced pressures downwards, towards allocating downwards. So managers can choose actions, clients can induce managers to choose actions, and we're looking at both of them. Country active bets, and then also the flow-induced fund allocations. Do I have your interest? I'm not going to show you much because we're running out of time. And so which funds made active bets? Which direction? What are the fund attributes of the ones that made active bets? Are they the ones that Kramer's and Petty-Easto say are the typical ones that take active share, have big active shares? And then what are the country attributes that are relevant, that link to the ones that experience the highest positive and negative flow-induced price pressure? So this is different than the aggregate tick flows data that I was looking at. Now I have names and places, names, ranks, and serial numbers of the people that are doing their stuff. I know who's doing it, and I know things about them. So that's what we're trying to do. So here are the funds. 135 families, 312 funds, $317 billion. Typical fund in the sample, about $1 billion. Here are the biggest guys. Oppenheimer, American Funds, Lazard. Who's the Jonathan's favorite yesterday? The guys that are super efficient? Capital Group? Did he mention Capital Group last night? Conventional Fund Advisors, third place, $17 billion. $29 billion Oppenheimer. These are the biggies, right? Rand Ford. So names, I got names. Not all of them are US based, huh? Not all of them US based. So lots of international clients, even for the US based. Here's the interesting thing. On average, we saw how people moved. You remember? We saw people moved on these countries in 2013. If you look at the subclass of investors called emerging market mutual funds, and you look at their average portfolio weights by country, the MSCI weights, here are their overs and unders as of December and then as of end of June, the end of the short, sharp shock. It's almost on average across the body of investors, no action. So you're tempted to say, well, there's nothing going on in this. So if it's not emerging market mutual funds, $312 billion worth of activity, who were the ones that were moving their money in May and June of 2013? Hold on. The aggregate hides some really interesting information here, right? There are some active players. Like the one I told you about, the fund that I talked to said, we held our ground steady. Yeah, but not all of them held their ground steady. And this is the change in the active share from before to after. And what you can see, this is a histogram of the change, okay? These are percents, and this is the frequency, so this is a histogram. And yep, it's true, the mode sits around 0. The vast majority of them sat and did nothing while they were watching Bernanke sitting in front of the House committee. But there are some interesting groups of funds out here and here. Some that actively took down their active share, negative, meaning they converged towards the underlying benchmark. I'm not exactly sure that they're all using MSCI emerging markets, but these guys took down their active bets. These guys widened their active bets. I want to look at these. I want to know who these guys are. I really want to know who doubled down. Who was doubling down and moving their clients' money, right? And whether the clients were moving it for them, right? Second part of the question. This one is a little bit different. It's a market timing measure where I look at the changes. This one creates the absolute deviation. So positive changes, negative changes. I'm just looking for how much changing. This one looks at the direction of the change and coincident with the returns on the market over time. So here prices come in. And I'm looking to see who increased their overweight on Brazil because Brazil was rocking and rolling, and who decreased their overweight or increased their underweight relative to the benchmark when the market was taking a tank, like in India during May and June. So both, positive, positive, negative, negative. We're looking for big numbers here in the market timing. You could be timing by avoiding on the downside and timing by chasing on the upside, right? And so these are the guys I want to know about.
In the mutual funds that you isolate,
Yeah.
I think mutual funds will have fixed point rate of return. We are going to always maintain this distribution of allocation.
Yes. Yes. So are they more passive or active?
Yes.
These are all active. They're listed as active emerging market mutual funds. But you know, like I know, that though you are active, you may be a closet indexer. And that's why we create these things called active share measures, which is a truth-telling serum on mutual funds to reveal their actual behavior. I go with the actual behavior to define them.
Because it understands whether there is a motive by requirement that if you get inflows,
Yeah.
you have to push it to certain pockets.
Correct. I've got one slide left. We've got 1 minute left. First of all, there are some really interesting characteristics associated with this. This is the change in market timing bets, that measure I just showed you, across mutual funds, 296 for which I can get data. I look at the traditional things that the mutual fund guys look at to see, this is Kirsty and I, lousy R-squareds, that's normal in this type of regression. But what we find is that the ones that were most strategic in timing their bets are smaller funds, not the larger, well-established ones, and the ones that had stronger returns. The ones that had high management expense ratios, irrelevant. You had a team versus an individual running the fund, irrelevant. Lots of talk last night about teams versus individuals, irrelevant in this space. So we look at all these relevant attributes. Size and trailing fund returns seems to have driven it. And the next question is, which were the EMs that were the focus of market timers? And here's just a quick little graph. This is the flow-induced fund allocations measure of Jodhikastira, Lundblad, and Ramadorai in the JF 2012. So it's basically taking funds with large assets, their weights as of December of 2012 in each of the countries, and then their respective flows. So you might have had a big fund with a small weight and big flows in, or negative flows with a small allocation and a small weight. I aggregate these up, they get to the country level, and I do a simple cross-validation of my 6 risk indicators, and guess what? It's not bad. It's not bad. This is not in the book. This is not in the book. It's not bad in explaining the cross-country variation in client-induced fund flows during May and June of the taper experiment in terms of which countries they were pressuring to exit and which ones the client-induced actions were pressuring them to enter into as it relates to that which you would have expected based on the risk indicators. And there's some weird outliers, right? Mexico, remember this is a weird one, right? They were increasing their actual flow-induced fund allocations. And based on Mexico's scores, you would have expected it to be negative. So it's kind of hurting my overall R squared. But not bad. Not bad. Who would have thought? Who would have thought? Totally understand. So ladies and gentlemen, thank you for staying and listening. I appreciate this very much, and the comments, and more to come, I hope. Have I, we, I, us, I'm just your voice box, right? For industry. Have we cracked the emerging markets enigma? Hardly. But there's some interesting learnings that I think are going on here. I thought 2013 is a cool experiment that fell into my lap. The softer constraints, that's, I think, one of the real headline messages that I emphasized in the last chapter. The softer constraints, the stuff you'll find 30% of the sessions at a financial management association focusing in on, where if you talk to people on the outside industry, their eyes might glaze over and not be so interested in as sort of the harder stuff. Well, we've got some validation here that the data says that those things seem to matter, whether they realize it or not. And so let's elevate their understanding of this. And like I said, stay tuned, lots more to come. And last questions? One more question from the group? You've asked all sorts of questions. Yusri.
Yeah, I'm wondering that whether, for example, the American investors say about China is the same way as the Chinese people say about ourselves, or maybe the US investors say about Mexico is the same way as the Chinese people say about Mexico.
You've offended all sorts of people also.
People may have the different benchmark to have to understand the weight on the risk factor.
I don't know. I'm really interested to take this stuff on the road and see the different impressions people will get in different countries around the world to what I say about their country. I'm sure many people will be very mortally offended and throw tomatoes at me. And others will say, oh, I knew it all along. And I'm looking forward to all of those reactions in the spring when I start marketing and selling this book. And I'm really interested to see the reactions coming back. And I hope you guys find something useful in all of this for your research, to frame the way you think and organize your thinking. And if you don't work in this area, well, 200 pages, you can catch up real quick. It's a nice synthesis of the literature. So we should stop.